Our next guest is as bullish as it gets among the U.S. equity strategists. He's Tom Lee, the chief U.S. equity strategist for JPMorgan, has the highest year-end estimate for the S&P at 1475. Tom, great for you to join us again. Also, Dominic here as well in on the conversation. And of course, the global atmosphere or what's going on overseas is very important for a lot of these companies. Alcoa, being a global company itself, the fact that they're saying that they're not seeing orders as high as they thought in Europe tells you what, Tom?
Well, I mean, I think it tells us that Europe's financial shock has been sufficient, in terms of credit tightening, I think to really hurt the economy. And our forecast from our European economists is for a mild recession to start either in the fourth quarter or sometime early in 2012. I do think the bigger question, because I think that's pretty much accepted by not only investors, but I think what's been reflected in markets, and something that had made intuitive sense to us, but we've seen it in the sell-off in European equity markets. I think the bigger question remains, is that going to be enough of a ripple to generate a global recession?
Well, Tom, one of the things that we talk about, this idea that it is spilling over, what exactly are the pieces of evidence that you're seeing? What exactly is showing you right now that there is this spillover hitting U.S. stocks and U.S. companies beyond just the idea that the financial crisis is, a big deal?
Well, there's historically, two very direct transmission mechanisms to make a U.S. recession. I mean, I think, and you really have to think of it as sort of two ledgers happening. One is really how it affects large multinationals in terms of order flow, right? Because as soon as large businesses start to see slowdowns there, they slow down their expansion, and it sort of causes a stair-step downturn in business activity in the States. And I think the second transmission mechanism that's very, very important is the financial markets. That if you have credit tightening taking place in Europe and spread widening, not only does that potentially lead to banks having weaker access to capital, but that could spill over to U.S. banks, hurt their balance sheets, and of course, as spreads widen here, it causes U.S. business having a hard time funding. Now the second has not happened in the States yet, and I think in the first, I think that there hasn't been sort of the surprise. The surprise is really what hurts U.S. businesses. That you suddenly see a sudden drop-off in orders,
right? And
then that spills over into all the supply chains. I mean, I think businesses really were on kind of red alert since March. So we're seeing very limited impact on U.S. industrials.
But why are you so bullish, though, Tom? I mean, why do you have a 1475?
Well, Betty, the reason we're bullish, and I'd have to say, why are we having a different view of the market is I think we've had a lot more faith in the ability for U.S. corporations and for the U.S. economy overall to still navigate through an expansion despite what looks like to be very, very scary headlines. And, I think some reasons for that is, one, the U.S. economy hasn't been as dependent on credit expansion. This has been an expansion that's taken place while credit's been contracting. Mm-hmm. But it also reflects the discipline of U.S. businesses. I mean, their cash as a percentage of assets at, almost 60-year highs. 11% of assets are cash. And then if you look at equity risk premium, which is really a valuation measure, it's still at 60-year highs. And so, I mean, it's higher than it was when we started the Lehman Brothers. It was higher than it was in March '09. I mean, today the fact is stocks are cheaper than any asset class, and so
right.
I think what.
Right, but Tom, just quickly, I mean, you've stuck with this forecast, though, even though we've seen huge volatility, this crisis in Europe spreading.
Yes, and Betty, in some ways, we talked about this roadmap in August that if this is 98, and I'm not saying this is like tracking 98, but if this is 98. The market made almost a 40% move in 4 months, and in some ways, the reality is that if we have a continued rally, and I think 1275 is a key level, I don't think people are going to start being constrained by the idea that, well, if the market's at 1275, that's the rally for the year. So I do think that the market is in a position right now to really show a pretty big impulse upwards.
All right, Tom, good to see you again. Tom Lee of JPMorgan.